You search a company, the numbers look solid, the industry is booming, so you buy in. And then the industry keeps growing, but your stock keeps dropping. So you start wondering, did I pick the wrong company? Well, maybe not. The real problem might be that you have no idea where the company actually sits in the industry chain. Think of it like bubble tea. Someone grows tea leaves, and that's upstream. Someone processes them into tea base, that's midstream. Someone runs a shop and sells you the drink, that's downstream. Same industry, three completely different jobs, three completely different ways to make money. Upstream wins on scarcity, midstream wins on scale, and downstream wins on brand. Now let's look at electric vehicles. The upstream would be lithium miners. No lithium, no batteries. Companies like Tianqi Lithium, they sell raw materials. Midstream would be battery makers. CATL, BYD Battery, they turn lithium into battery packs. And downstream would be EV brands. Tesla, NIO, XPeng, they put batteries in cars and sell them to you. Here's where it gets interesting. Tesla announces a major price cut. Tesla buyers may think, well, lower price, does that mean more sales? And it's great news. But if you understand that Tesla is a dominant downstream brand, you realize something else. A price cut means Tesla is squeezing its suppliers upstream. Battery makers' margins get compressed. Lithium demand expectations drop. So what happens? Lithium mining stocks crash. So the same industry, same news brings opposite outcomes. Now flip it. EV sales are still climbing, the whole industry looks healthy, but if you're holding lithium stocks, you notice something weird. Sales are up, but lithium prices are falling. Why? Because lithium is an upstream cyclical commodity. When EV demand exploded a couple years ago, everyone rushed to buy lithium. Prices went to the moon. Miners overexpanded, and now supply is flooding the market. Sales are still growing, but lithium prices have already collapsed. If you don't understand upstream cyclicality, you never would have exited at the top. And that's the power of knowing your position in the chain. So here's the takeaway. Buying a stock isn't about buying a good company, it's about buying the right position in an industry. Before your next trade, ask yourself 3 questions. 1. Where does this company sit in the supply chain? 2. How does this position actually make money? Resources, technology, or brand? 3. Is the current industry trend helping or hurting this specific position? Getting those 3 answers, and you're thinking like a real investor. One last thing, an industry going up doesn't mean your stock goes up. Because in the same industry, when upstream is feasting, downstream might be starving. And when downstream is booming, upstream might already be crashing. Knowing your position in the chain matters a lot more than knowing which company looks good. Okay, bye. Please follow and subscribe.